If you ask any financial advisor, read any investing blog, or watch any wealth creator on YouTube, they will all tell you the exact same thing. Play it safe. Use dollar cost averaging. Spread your money out over time. It is the golden rule of modern investing. But what if that golden rule is mathematically flawed? Researchers at Vanguard crunched the numbers across decades of market history and found a brutal truth. Dollar cost averaging actually costs you money, 68% of the time. In this video, we are going straight to the math. To understand dollar cost averaging, let's strip away all the emotion and look at the raw mechanics. Imagine you receive a $12,000 windfall, maybe an inheritance, a bonus, or the sale of an old car. You have exactly two choices. Choice A is lump sum investing. You deploy the entire $12,000 into the market on day one. From minute one, your capital is 100% exposed to the market. Choice B is dollar cost averaging. To reduce your anxiety, you invest exactly $1,000 on the first of every month for 12 months. Psychologically, choice B feels phenomenal. If the market crashes tomorrow, you still have $11,000 in cash. But here's what's actually happening mathematically. In month one, you have $1,000 working, $11,000 doing absolutely nothing. By month six, you still have $6,000 on the sidelines, yielding exactly 0%. This is called cash drag. While you wait for a crash to deploy your safety net, inflation and the market's upward drift are silently eroding the value of your uninvested cash. Look at this chart. We are visualizing your $12,000 deployed across 12 months. The amber bars show capital that is actively invested and working. The red bars above them show capital sitting in cash, earning 0. Watch as each month passes. Month 1, 1,000 deployed, 11,000 idle. Month 3, 3,000 working, 9,000 still sitting out. Month 6, you are finally halfway deployed. $6,000 has been idle for an average of 3 months. The flat blue line at the top shows where lump sum was from day one, fully deployed at 12,000. Every dollar of red shading you see in this chart represents a dollar that had 0 exposure to market gains. This is the hidden cost. Not a fee, not a tax. Just the mathematical penalty of keeping capital on the sidelines while the market moves without it. So, why does this matter historically? Because Vanguard studied this exact question across the United States, United Kingdom, and Australian markets using data from 1976 all the way through 2022. The result? In 68% of all rolling 12-month periods, tested. The investor, who deployed their money immediately as a lump sum, ended up with more money than the investor who dollar cost averaged. 68%. 2 out of every 3 scenarios in history. Lump sum won. And, in those winning scenarios, lump sum outperformed by an average of around 2.3% per period, which compounds into a significant gap over a decade. So why does DCA win in the remaining 32%? That is exactly what we are about to break down. To really stress test these two strategies, let us apply them to the most volatile major asset on Earth, Bitcoin. January 2016. Bitcoin is trading at around $430. Watch what happens to the price over the next 2 years. Slow for most of 2016. Then, in 2017, it absolutely explodes. By December 2017, Bitcoin has reached $13,860. Now let's count the BTC you would have accumulated under each strategy with your $12,000 starting capital. The lump sum investor deployed all $12,000 on day one at $430. That buys 27.9 Bitcoin. The dollar cost average investor? Because they deployed $1,000 per month, each month they bought at a higher price as the asset rallied. By the time all capital was deployed, they had accumulated just 18 Bitcoin. That is a gap of nearly 10 full Bitcoins, permanently lost in purchasing power by choosing to wait instead of commit. In a rising market, time in the market is everything. But now let's flip the scenario completely. January 2018. Bitcoin has just peaked near $14,000. Euphoria is everywhere. Every news channel is covering it. Your $12,000 windfall arrives right now. What happens if you go lump sum at the peak? Watch. The market crashes. Hard. Bitcoin falls from nearly $14,000 to $3,700 by year-end, a 73% decline in 12 months. The lump sum investor who bought at the top ended up with just 0.86 Bitcoin, and their portfolio lost most of its value. But watch what happened to the dollar-cost average investor. They deployed $1,000 each month as the price collapsed. Month 2. Buying at $11,000. Month 5, buying at $7,000. Month 9, buying at $6,000. By the end of 2018, the DCA investor had accumulated 2.1 Bitcoin, more than double the lump sum investor's stack. This is the 32%. In a sustained crash, DCA is not just better. It is a completely different mathematical outcome. The crash was DCA's greatest ally. Let's now look at something more accessible than cryptocurrency, the S&P 500. Using verified historical annual returns from 2012 through 2024, we are going to race $12,000 through lump sum versus dollar cost average. The cyan line is lump sum, fully invested from day one. The amber line is DCA, 12 months to fully deploy. Watch the gap begin at year 1. The lump sum investor is already further ahead because they captured the full return of 2012's 16% gain. Through the bull years of 2013, 2017, 2019, 2021, the lump sum line pulls further and further ahead. Notice 2018 and 2022, the down years. The gap actually narrows slightly when markets fall. This is DCA's partial defense mechanism activating. But over the full 12-year period, the gap is clear. Lump sum finishes meaningfully ahead, a difference that compounds year after year. So if the math so clearly favors lump sum, why do financial advisors still recommend DCA? Because human beings are not mathematical algorithms. We suffer from what behavioral economists call loss aversion. The psychological pain of losing $10,000 in a crash feels roughly twice as intense as the joy of gaining $10,000 in a rally. That asymmetry is hardwired into us. Dollar cost averaging is not an investment strategy designed to maximize long-term profit. It is an emotional insurance policy. You are intentionally paying a premium, the cash drag opportunity cost, in exchange for peace of mind. For investors who know they would panic sell at the first crash, that premium is absolutely worth paying. Because a portfolio you actually hold through volatility beats a mathematically superior strategy you abandon at the worst possible moment. Let's summarize what the data tells us. 1. Lump sum outperforms dollar cost averaging 68% of the time, based on Vanguard's historical analysis. 2. Markets trend upward roughly 74% of calendar years. Keeping cash idle means betting against those odds. 3. In bull markets, early capital deployment results in significantly more asset accumulation. 4. Dollar cost averaging wins in 32% of periods, typically during sustained bear markets or crashes. 5. DCA is essentially an emotional insurance premium. It costs you roughly 2 to 4% in annual returns in exchange for reduced psychological stress. 6. The best strategy depends not just on the math, but on your ability to hold your position through volatility. Everything in this video is for educational purposes only. Nothing here constitutes financial or investment advice. Always consult a qualified financial professional before making investment decisions. If you found this data-driven breakdown valuable, hit the like button and subscribe for more evidence-based financial analysis every week. Until next time.